All righty. Get this live stream going. And well, awesome. Welcome everybody out tonight to our REI Genius workshop. Excited to have you all with us this evening. And tonight we have Tate Siemer, who is the visionary and CEO of Greenlight Equity Group, which currently owns 595 units, totaling $49.5 million in value in both Oklahoma City and Columbus, Ohio. Tate's passion is improving apartment buildings in such a way that maximizes the value of the community in order to provide solid returns and solid, consistent returns to investors and the well-being of residents. Tate and his team operate clean, safe, progressive communities that promote a thriving living environment. Tate hosts the Apartment Guys podcast and serves on the executive board of the Utah Real Estate Investor Association. That's awesome. He enjoys helping fellow investors and entrepreneurs through mentoring and coaching. Tate's other passions include big mountain skiing and mountain biking, music, and hiking with his dog, Joey. Tate, welcome to the REI Genius community, brother. Glad to have you here tonight. No, I think you're muted.
I was muted. Yeah. It gets you every time, right? Yeah, no, it's great to be with you all. And I hope that I can bring some really great value tonight. I would encourage everyone to just set the intention to get one really great, like what I call a $50,000 idea takeaway tonight, whether it's from something I say or from a question or just anything. Like, set that intention. It's amazing what'll happen, and participate, really be here and show up. And so yeah, like I said, it's an honor to be with y'all.
Awesome. Hey, well, I'm gonna let you come in your own way, brother, and get rolling, and then we'll do a little Q&A on the back end. And yeah.
Awesome. Well, I had a slideshow for you guys, and I am struggling to find it, to be completely honest with you, in my library of files. And I think that this can be really valuable in the sense of almost like a mastermind type format. So I would encourage everybody that's present that would like to participate to really ask questions, bring your own your own stuff. Like, maybe think right now about one bottleneck in your business that is kind of continuing to hang you up or something along those lines. And think about this almost like mastermind session from that standpoint of really like digging in and seeing what you can get out of this for yourself. So my name's Tate Siemer. I'm actually continuing to look for this presentation as we speak. So hopefully I'll have a little visual here for you in a second. But basically I am a multifamily investor. As Johnny said, my company, which is called Greenlight Equity Group, we have a portfolio, 7 different communities, 4 of which are in Columbus, Ohio, and 3 of which are in Oklahoma City. We're currently under contract on a property in Lawton, Oklahoma, where it's a real heavy lift remodel where everything is needed on this thing. And so we're excited about that one. We've got a great strategic partner, which is key on something like this, as you all might imagine. And so basically, our portfolio is one that we built over the last 3 years. So I haven't been at this too terribly long. My background in the real estate world is in the single family space, like so many of us. Started out flipping houses in 2006, and eventually got my real estate license. Was a realtor for a while there, and then the crash happened. And during the crash, I kind of got sidetracked into some other businesses, and then in 2011 started flipping houses hot and heavy again here in Salt Lake City, where I live. I have a partner named Carl York, who has been with me really the whole journey, so to speak. And we did the single family thing as hard as we could, thinking we were doing it smart. We didn't really we couldn't really scale that business. And I don't know if you guys have ever heard that one before, but the single family space is tough. It's tough to scale. And it's a paycheck. You flip a house and you make X amount of money and you move on to the next one, and you're not building cash flow. You're not building wealth. You're not building equity growth. You're not getting really tax advantages or anything like that. So it took us about 7 years to kind of figure all that out. And we thought the next smart step for us was to go into development. So we got into some land entitlement projects here in Salt Lake City, where we would buy individual parcels of land and have them entitled for multifamily projects, high density, and then we would sell those projects without breaking ground on them to other developers and builders. And then we actually built some new build townhomes ourselves about 4 years ago. And those went terribly sideways and were by far the hardest and worst deals we ever did. They were beautiful products, high-end luxury townhomes downtown Salt Lake, but they were really rough from a numbers and at the end of the day, a loss, an economic loss on those deals. And in the midst of all of that, we had a little 12-unit apartment community come along that was in Salt Lake City. And by come along, I mean, it was brought to us by a wholesaler that we've done other deals with. And it was kind of teed up and ready to go. It needed everything. It was a full remodel. And we bought it, and we brought a builder in and remodeled it head to toe, everything from the TPO membrane roof to all new 90% or 95% mechanicals to LVT floors and windows and exterior paint and interior remodels. We doubled the rents. And again, this was 3.5, 4 years ago now. So in the process of doing that, we created a fair amount of equity. We sold that project to recapitalize based on where we were with the townhome projects. And that was really our launch into the multifamily space. For us, it was I remember vividly sitting down when we got that deal and we were looking at the pro forma and the underwriting, and we're going, there's this weird thing in the underwriting called income and rent. And this changes everything now. This makes it so this property is actually producing money while we own it. That's craziness. We had never, in probably 60 deals or so, we had never seen anything or done anything like that. And it was a real gift, I think, from the universe to have that deal come along and at that scale and to get us into the space. We then bought a 20 unit here in Utah as well. It was again a full remodel. We spent like $30,000 a unit on the remodels there. Total repositioning play. We sold it, did very well on it as well. And really, after that first 12 unit, I knew 100% that I wanted us to go laser focus, nothing but apartments, larger scale, commercial, residential real estate. So I went after thinking big and thinking the bigger, the better. I signed up for a coaching mentorship program with the big kahuna, Corey Peterson, out of Phoenix, who maybe some of you know, and really learned the business from him. got a lot of confidence from him because he was willing to be on my team and be part of our like our credibility kit that I put out about our company. He was willing to partner with us when we found deals. So that's really how we started going after the bigger scale deals. And by bigger scale, I'm, 125 plus units at least. And then we started buying in 2021. We bought 6 different communities, 192 units, 179 units, 60 units, 70 units. And those were all in Columbus, Ohio and Oklahoma City. And you may be asking, why did we go there? Why didn't we continue to invest in Utah? And the answer to that is that when in a traditional syndication model where you're paying a preferred return to your investors, you have to have a property that cash flows. And Utah, the cap rates are just too compressed. It's too expensive. You're not going to be able to cash flow a property here, likely. And therefore, we just kind of got to a point where we knew for sure that Utah wasn't our market. And I'm from Cincinnati, as I mentioned. So Columbus, Ohio is very familiar to me. It's a fantastic market. I'm extremely bullish on Columbus. I was bullish before Intel announced their $20 billion microchip factory that they're building on the northeast side of Columbus. But that is a game changer. And like something like a dozen other tech companies have announced they're moving to Columbus because of that. Yeah, Sassy says she loves Columbus, Ohio. So do I. I actually really like going there. I'm going there on Monday. And it's a fun city. Easy, no traffic, easy to get around, and a lot going on. So and then so Oklahoma City, Intel, exactly. Intel is building the microchip, and the CHIPS Act passed through Congress, which is providing a lot of funding for this stuff. And supposedly, like, this is the first of 5 phases they're going to build. So it could be as much as $100 billion project when it's all said and done. So we actively continue to pursue deals in Columbus. We're working on getting one under contract right now. That's an existing building that has about 18 units. And then it has a big piece of land behind it that we have permitted plans to build 26 more units on. So I love this deal, and I'm really hoping that we can wrap it up, get it under contract. So this year, 2023, I'm hyper focused on raising capital. It's really my mission this year is to get really good at both organic capital raising, and also just networking with other capital raisers, co-GP, et cetera. And even institutional larger check writers like family offices and that sort of equity source. So we found, I mentioned bottlenecks in our business earlier. We found that we got really good at getting deals, finding deals, and getting them under contract. And we weren't as out front with our capital raising efforts as we were with our acquisition efforts. So it's been, it's a part of our business that let's just say there's a lot of opportunity for improvement and transformation inside of that part of our business. So that's really what we're about. Johnny mentioned I do have the podcast, the Apartment Gurus podcast, which is 3 years old. About 180 episodes are out. It's all interview based. I do an occasional solo episode, but it's almost always interview based. And we have really great guests. Like, I'm just constantly amazed at the caliber of guests that I'm blessed with on the show. And yeah, Johnny would love to have you on at some point. I love being introduced to new guests. And I love going on other people's podcasts too. So I'm a big believer in the thought leadership space. I think you can make a big impact there. And I think it's one of the best ways that there is to network, build your network, build your sphere of influence, and kind of get out in front and show people what you're up to. So I can kind of delve in a little bit more in depth to any of the stuff that I kind of touched on. If you guys would like, I can talk a little bit about mindset stuff, which I think is foundational in this business. I can also talk about just what it takes to go from not having done a deal to getting to the closing table and doing a deal. Like, I live in that world all day, every day, because I have a coaching program where I have clients that are in that venture of getting their first deal done. So I help people build their brand, their business, their credibility, everything else that they need to get their business going. And then I'm there like every step of the way as they move through deals and deal flow and that sort of thing. So Reginald has his hand up. Yes, sir.
Hey, how you doing, sir?
Great. How are you?
Man, I'm doing great. I had two quick questions. My first one's gonna be really quick. How do we get in contact with you?
Yeah, you bet. I'll give you a few different ways. So our landing page, our website is investwithgreenlight.com. And my Calendly link is there. You can book a session with me there if you want. Just a jam session, no pitch or anything like that. It's just a chance to consult and see what kind of possibilities might be there. I just really like to help people. And I get a lot of traffic from the podcast, people that are looking for help. But and then I'll just go ahead and give you my email address, which is a very direct way of getting me. It's Tate, Tate at glequitygroup.com.
Do you mind dropping that in the chat, please?
No, you bet. Yeah. In fact, I'll drop my whole contact here.
We'll share that toward the end too.
Yeah. But yeah, very, very happy to connect. And I love Zoom meetings. I'm on them kind of, it seems like all day, every day, some days. But I think this post-COVID technology that we have access to now is like kind of game changing, honestly, like the chance for all of us to hang out tonight. And
no, most definitely.
Yeah.
My other question is myself and my partner Johnny, we closed on 96 units last year. It's my first apartment, first year in real estate investing. And I know we had a few challenges with like the banks. You know how the banks do as far as changing things up in the middle of trying to close on a deal, even up to the week before. So looking into starting a fund, and I noticed that you were raising money. Can you talk a little bit about, what made you want to start a fund, how you started the fund, what type of reg you use, how do you get that organic, just the whole thing through that with getting that going?
Yeah, no worries. Good question. I think a fund is in our future here in the next 6 months ourselves. We've raised capital on a deal by deal basis up till now. So I really think that a fund model is ultimately, if you're doing, deal after deal, and, let's say 2 to 4 deals a year, I really think that having a fund in place is the way to go. I think it's easier to raise for a fund myself. if you do it well and you know what you're up to. And by the way, this isn't coming really from experience. It's coming more from like a lot of talking to a lot of people about doing this and considering doing this ourselves. But I think there's a lot of strategic advantage. And then, you know, when a deal does come along, you already have capital. You're already ready to rock. And the difference between that and looking at, okay, we've got 60 days or 90 days or whatever to raise this capital. Otherwise the deal doesn't happen. Like that's a real different kind of place that you're in. As you know, did you guys raise capital, Reginald, for that 96 unit?
Yes, we did.
Okay. And how did you do that? Did you go to like your investor your sphere of influence kind of list and do a webinar, or how'd you guys do that?
So to be honest with you, I was more on the operations side. So I brought the deal, helped underwrote it and brought the team to kind of take it down. Johnny probably can talk more for his raising the money because he was definitely the brains to that, bringing that together.
Okay. Well, I'd be curious because, you know, like I said, this year to me is I'm actually going next week to this conference in Louisville called RAISEFest that Hunter Thompson is putting on. Hunter wrote the book Raising Capital for Real Estate, and I think is kind of a guru in this space. So anyway, this will be my first event with him, but I'm doing that next week. And really excited about that. I'm excited about raising capital in general. I think after doing this business for a number of years now, I really think that it's the most valuable activity that there is in real estate. Being able to put capital together, going out and finding good deals and structuring good deals is super valuable. I'm not taking anything away from that at all. But I think, you know, consistently being able to source capital and deploy capital into good deals is like where the rubber meets the road. There's a couple of hands up. Reginald, are you still hands up? You're on mute if you are, bud.
Yeah. Hey, Tate, for the 96 unit, we ended up doing like a joint venture and bringing on like 5 investors.
Yep.
That came on board, which this was looking to hold more long term than kind of going full cycle in 5 or 7 years.
Yeah. Okay. So you're thinking of holding past 5 to 7 years.
Right. Yeah, we'll refinance around year 2 and just kind of hold on to it for a while.
Nice. Very nice. That's a big asset to joint venture on. Yeah, that's great. Sassy, what you have your hand up there.
Hi, Tate.
Hi.
Thank you. So my question is kind of like a few parts. So in all the deals that you've done, right, have you ever creatively financed a multifamily deal? And if so, how many units was it? Like, was it a larger? I know it's possible to creatively finance a larger multifamily, but have you done that? And what was your experience like for you?
So if by, excuse me, if by creative finance you mean seller finance and buying on terms, we have not done a larger scale seller finance deal. We have assumed a few notes when we bought properties, which is quite different, obviously. But to me, look, subject to deals, you know, seller finance deals, creative financing deals, whatever you want to call them, they are going to be over the next year to 2 years a thing, in my opinion. And I would think along the lines, guys, of when you're writing offers, if you're writing LOIs, which is the way most people write offers in this space, throw out 2 to 3 or 4 options for the seller to consider. One of which is a seller finance option. And you're going to say something to the effect of like, look, I know you want $6 million for this property. Like if I'm going to go out and get a new loan at 7 to 8% and come in and with the income that this is producing, I'm sorry, I can't pay more than like maybe like 5 million for it or 4.8 million for it. However, if you're willing to consider, you know, this option that I have, I can probably get pretty close to your price, if not achieve your price at 6 million. And essentially, you know, you just get creative. I mean, you guys know how to do this. You get creative. You put together a nice, very attractive down payment that's going to make them feel rich. And, you know, and then you do a very low interest rate, ideally loan with maybe interest only terms. Some people do principal only terms. And, you know, you get yourself a nice, maybe 10-year balloon or, you know, depending on what the seller will do. And like, I just am a huge believer that this solution is going to be something that you see a lot more of, that, and it's going to be able to solve a lot of problems that otherwise would be pretty unsurmountable. So I like how you're thinking, Sassy.
Yeah, that's the option. That's the way I want to go, because especially with commercial lending, they like have gotten really tight with their commercial lending. I was reading an article that said that even people who have the money, they have the credit score, a lot of commercial institutions are not approving loans.
Yep,
commercial, right. You know, and when I started thinking about that, it's like, you got to get creative, because the reality is you have some people who own apartment buildings and they don't want to be landlords anymore. Or maybe right. They decided, well, I'm going to do it on my own. I'm not going to hire right. a property management company to help manage it for me. I can do it on my own. And they're finding that it's way more work. And they probably, some people, I've talked to some investors, they was like, look, I'm getting old. Yep. Like, I'm getting old and I don't want to be bothered with this anymore. So I think for me, that's the way I want to go, is like some sort of creative financing to do deals. So I was just curious about what is the minimum amount of units that you are interested in? Is probably high at this stage of the game for you, but what is the minimum?
We'll actually look at smaller to medium deals right now, just based on this market. We feel like you got to kind of go where the opportunity is sometimes. And I think there's opportunity in the mom and pop space, like you were just talking about, people that are just tired and aren't doing a good job with their property. And so, I mean, you know, to look at a 20 or a 30 unit is kind of tough. You just lose the magic of scale when you're that small. However, I mean, a deal's a deal, and if it's doable, it's doable, and we'll look at those. But I mean, I start to get excited in the 40 to 80 range, and then start to get even more excited above that.
Okay. Have you found that because one like commercial, because I'm a realtor, but I also do commercial as well. And one guy said to me, another broker, he said, the higher you go up in units, the less you'll find mom and pop. Have you found in your experience that
yes.
Usually the smaller units, the smaller amount are mom and pop, not the larger ones? Okay.
Yep, that's correct. Now, you do have mom and pop in the larger scale stuff. You don't have a lot of savvy big time investors in the smaller stuff.
Right.
Because one of the magic aspects of multifamily is leverage. So you might as well, if you're doing this, you might as well take advantage of all the leverage that you can. And one way of doing that is buying as many units as you can.
Okay.
So, and you know the old adage about it's just as easy to buy 200 units as it is to buy 20. I mean, to some degree, that's true, especially if you have your equity figured out for that. I think that's actually very true. It's certainly easier to buy 200 units than it is to buy 10 units, right? So, you know, scale's your friend. It's one of the reasons that we're here. But here's what I would focus on, Sassy, and anyone else like interested in creative financing. Get really good at having that conversation with the seller about that option, and be able to explain it in a way that that makes really clear sense to like a third grader,
Okay.
because it's a tough thing for some people to get their heads around, and a confused mind says no.
Right.
They're going to be like, no, I'll just take my money. I'll pay the taxes and take my money. Right.
Right.
So I would script it out. I'd write it out and I'd practice it.
Okay.
Like, and you want to stay away from things like, I mean, I wouldn't even use I don't know that I would use the term seller finance.
Right.
Some people say be the bank. Like, to me, that's a little weird. Like, it's basically like, hey, what I can do on this for you at, you say you want 6 million. Okay.
Mm-hmm.
I can come in and get you a 10% down payment. So I can get you 600 grand. And then I can basically pay you off over the course of the next, whatever, 5 years, 10 years. And you're going to get X amount, and you figure out what that is, in a check from me every single month.
Mm-hmm.
And it's not going to be taxed the same way as capital gains gets taxed. So you're going to be saving on taxes,
Mm-hmm.
and I'm doing all the work, and you have the security of still having a note on the building.
Right.
And so I'm not using, in that whole thing, I didn't use any real weird words or like,
Right.
you know what I mean? You just want to like, and you kind of like the whole sales idea of like assuming the close too is a good one. Like, you just kind of want to say like, all right, so here's what you're going to do. And then here's what I'll do. This is the way it's going to work, all that stuff. So, but I think that strategically speaking, like having that in your pocket, it's not, I would use it as a tool, right? Like, it's one of many tools that you have. It's not like you're only looking for this strategy right now, because if a deal's a deal,
Right.
and if it's a good enough deal that you can get it done with conventional financing and like joint venture partners or LP investors, by all means, in my opinion, by all means, keep doing deals. Like, that's where I am. Like, and what I care about right now is cash flow and fixed long-term debt. Because if you have those two things, you're recession proof.
Gotcha.
Right? The building is paying for itself. It's paying its bills. It's ideally paying your investors and maybe even paying you. And I lost my train of thought. What was the second part of that? It's
Deals.
yeah.
I was writing down. I'm sorry.
No, it's all right. It'll come back to me in a sec. But yeah, oh, I know, it's fixed rate debt. So, if you know that, look, even if it's like a 6% rate right now, like that's obviously not ideal compared to what we've had,
Mhm.
but it's also not bad. And if you can make a deal go at that and you can fix that rate for 5 years, it's worth, if it pencils, it's worth considering, strongly, in my opinion. So that's the way to do this business in a way that like lets me sleep at night, with knowing that I'm doing the very best I can for my investors and my residents for that matter, but buying properties that are either solvent on day one or I can get solvent really quickly.
Okay. Okay. Are you open to, my last question, because I don't want to hog up the time. Are you open to people, or are you okay with people bringing deals to you? So Columbus,
Yeah.
Ohio is a market that I want to be in.
Yeah.
But I also know other investors in Columbus, Ohio. That's their market too. But I just wanted to know if you're open to that, if it's a big enough deal, and of course the numbers make sense. Okay.
Absolutely. Yeah. I mean, I'd say aside from like single family and fourplexes and that sort of thing, like if, anything you think might be worth looking at, I would take a look at, even if it's just a matter of like telling you what I think, it might be worth for you. Even if I'm not involved, I'm happy to help any way I can. And the more of us that know each other in a market, the better we are, because it just gives you more options.
Yeah. Yeah, absolutely. Absolutely. That's awesome. Thank you so much, Tate.
Yeah, you're so welcome. Joel, sir, you have your hand up there.
Yes, sir. Thank you. Tate for his presentation tonight. And I agree with everything you said about the creative side. I'm really interested in the creative finance and especially. And I've been listening to a lot of information about creative financing, and bringing at the time is probably right now with the interest rate going up to try and get much as we can. But one thing you said earlier that is sort of I need a little bit more explanation about it is you said that cap rates were sort of compressed, and I guess I'm still trying to wrap my head around cap rates, the difference in cap rates. I understand the formula about how purchase price equals the cap rate, and also about the how divided by the cap rate equals the purchase price. But put that cap rate on the bottom and it just compress. I guess by compression meaning they're going down, and if the denominator goes down that equation, then the value should go up for the purchase price. But explain to me what compressed cap rates mean.
Got it. Sorry, my dog might bark here for a minute. Somebody's arriving at my house. So, all compress when cap rates compress, what that means is that people are willing to spend more and more for the same amount of cash flow. Or another way of looking at it is, people are willing to take less for the amount of money that they invest. And another way of looking at it is prices are too high or are high. Too high is a judgment, but prices are high. When cap rates compress, prices are going up. That's what that means.
Okay.
Yeah.
Prices going up.
Yep. So yeah, good question.
When you say compression, you mean the cap rates going down? You said cap rates going
down? Yeah. Cap rates going down, meaning prices are going up.
Okay.
Yeah. It's an inverse relationship. It's a little confusing, but once you get your head around it, it's pretty simple.
Okay.
Yeah. So when you hear somebody say like the market cap rate is compressing in this market, that means that that prices are going up and the income from the property is not going up congruently.
Gotcha.
So, yeah. So any other, Faye, looks like your hand's up. Hi,
yes.
Faye.
Yes. Hi, Tate. I just wanted to say thank you for being here and spending time with us. I'm glad you mentioned about Hunter Thompson, that what's his one? The event that you will be attending. So by the way, guys, I was just chatting with him. We'll be having him here.
You were just chatting with Hunter?
Yes. Hunter
Cool.
Thompson, yes. Yeah, so we'll be having him here as well in the REI Genius community. But yeah, my question to you is, knowing what you know now in terms of like the scalability and the capital raising, what would you have changed in the past probably year?
Yeah.
To, in terms of the strategy, the approach, and
it's a great question.
Done better. Yep.
It's a great question. I would have gotten out in front of our investor base a lot more and a lot earlier than I did. And I would have started developing that investor list more. Everybody here, if you're serious about raising capital, you should have an online presence that kind of looks like the following. So you'll have a landing page that's very investor centric. This is Sassy's Capital. This is what we do, or not. This is what we do. This is how we can help you. We are an amazing alternative to the stock market. Here are all the ways that multifamily real estate can serve you. It's very, very investor centric. You have a click magnet, which is like a downloadable asset. Like think about maybe a 5 or 6 page brochure, like an e-brochure, some kind of guidebook or something like that, people can download, and in exchange for downloading, they enter their email info, and basically get on your investor list, get into your database automatically because you're all integrated that way. So So yeah, they come in. Hey, hold on 2 seconds here. So you basically the click magnet auto loads their contact information into your CRM, your customer relations manager, client retention manager, whatever you want to call it. Your CRM is you're the center of your investor pool. And that's the list that you're growing. And then once they're in the CRM, you can set up an automated series of emails to them that are essentially value add emails, and they all have a call to action to book an appointment with you. So that the end goal of all this is that you get an appointment with them, ideally in person. If not possible, then you do it on Zoom. And that's how you're converting your investor list. So everybody should have that set up. It's not super easy to just kind of start from scratch and build that yourself unless you're really techie, and I'm not. So there's one service called Good Egg Investments. I have no affiliation with them, and I don't even know them, but Good Egg Investments will actually build all this stuff for you and give it to you turnkey so that you're ready to rock right out of the gate with all your emails written, your click magnet content written, all the integrations are in place, your CRM's ready to go. And of course it's not inexpensive to have them do it, but it'll basically, compress your timeline. Speaking of compression, it'll compress your timeline way down if you have somebody build it for you. So that's one thing, Faye, to answer your question. I would totally have had Good Egg build our system for us if I could go back and do it differently. Whatever it costs, I would pay it. Because to have somebody that knows exactly what they're doing and exactly how to do it, to have them actually do it, is, you're hiring an expert. So that's
100%.
leverage,
Absolutely. So I just a follow-up question on that. For someone who has, and this is probably a little segue to the mindset part of it, because you mentioned if you could have done it better, you would, want to invest and get started with the right systems and processes in place. What if my thinking was, I could have used that funds to actually buy a deal?
Just to be real with you, I think that's short-sighted. I think investing in your foundation and your education and in your systems and processes that are going to bring you deal after deal after deal is a much smarter place to invest. So if somebody said to me, look, I've got 30 grand, I want to start investing in real estate, what should I do? I would say hire a coach for 30 grand or 25 grand or whatever it costs.
It. Yes, that's
beautiful.
Because
look,
thanks, Tate. I think Johnny has a question.
Oh yeah, for sure. Yes, sir. Johnny.
Yep. No, great information, Tate. I did have one question too, while we're waiting for any other questions to pop up. So how's it been with you, living in Utah with just for the asset management side of it, with taking down deals on the other side of the country? You guys kind of have a member of the GP that's kind of boots on the ground there, or?
Kind of, sort of. In Oklahoma City, not. In Columbus, we have a boots on the ground partner on 3 of our deals. It definitely presents challenges. There's no doubt about it. Luckily, Salt Lake City is a Delta hub, so I can fly direct just about, except for Columbus. I can't fly direct to Columbus, but it's it just by nature of not being able to drop in on your properties and drive by and check on things, it definitely creates a need for other ways of effectively managing the asset. And the reality of that end of things is it's 100% the property manager that you choose. Like, really comes down to that. And you can manage the heck out of a bad property manager, and it's still going to be a bad property manager. And you can manage the heck out of a good property manager, and you're going to get results if you do that. But either way, you need to really proactively manage the property manager. Make it super clear what you're expecting. Real quick, I'll just drop this. My friend David Tupin, who maybe some of you have heard of or run into, he has a document that he creates for all of his properties called an asset management plan, like an AMP. And he writes it up, like everything that they're going to do to that property, all the expectations they have of it, all the metrics that they want to make happen. And then he has a professional designer like design it into a brochure. And then he has everybody involved with the property read it and sign it. So like his property managers, his construction managers, his leasing managers, like they basically are all on the same page as to how to manage that asset out of the gate. And we haven't done this yet, but we're going to do it on our next one. And I think it'll be a real game changer. And if you guys want to email me, I can, I'll check with David. I've got his example asset management plan. I'll check with him and make sure I can share it with you guys. But if you want to email me, I'll see if I can share that with you. I think it's really, really cool.
Okay. No, I'll email you and get in touch with you. I think, yeah, that'll be great, especially I would love to use it for what we're doing right now as we continue to manage our asset that we got down in Montgomery, Alabama. But I think for those that's looking, because I do have some in the room that's definitely looking to get more into multifamily space as well too. So I think that's a great source.
Yeah. Cool. Any other questions popping up right now? Reginald's got his hand up again. So does Sassy.
Yep.
Hey,
One last
I
question.
had a quick question. Mr. Tate,
Yes, sir.
is there a particular underwriting tool you use, or what do you do as far as your underwriting?
Okay,
What do you use as far as your underwriting?
The politically correct answer to this is I use a product called Real Estate Lab that sponsors my podcast. And Real Estate Lab is an online online web-based acquisitions management platform. And it's actually fantastic. It's got really sophisticated underwriting. It'll actually parse out from a rent roll and from your financials, it'll parse out full underwriting, like budgets and everything else. It's extremely capable. And David Tupin is a stud. He's a great guy. He will hook you up and make sure that everything's running right for you. The reality is last year was just kind of a weird year for us. And we had a big deal in Columbus under contract that I haven't mentioned. It was actually a huge deal, and we didn't get the deal done because we had an equity partner drop out at the last minute. And so a lot of our year was consumed with getting that deal done, and we didn't really focus a whole lot on other deal flow because we just didn't really need it. So we're not necessarily underwriting like 3 deals a week or 5 deals a week. I can generally tell with a deal whether or not it's going to pencil these days. But to answer your question, Reginald, the correct answer to your question is I use Michael Blanc's SDA, syndicated deal analyzer.
Yeah, that's what I use. Yeah.
So that's what I use. I'm very familiar with it. I can get around it really fast now, and I can get something underwritten pretty quickly. That's what
I use as well.
I would recommend, not just because David's a friend and not because he sponsors my podcast, but I would recommend checking out Real Estate Lab, REL. It's actually got a community as well. So it's like there's networking involved too, which is kind of cool.
I definitely will. You said Real Estate Lab?
Lab, yeah, LAB. Yep.
Okay, thank you.
Yeah, my
Uh,
pleasure.
Just a quick side note here. So if you're more on the sophisticated side of things, you might want to check out the Michael Blank analyzer. But if you're just getting started and want to, get familiar in terms of the multifamily and underwriting, I would highly recommend David Tupin's calculator, because that's less, well, it is
Yeah.
sophisticated, but not as sophisticated as with Michael Blank's, with all the capital raising, all these other good stuff. But yeah,
Yeah.
thank you. Sassy?
Are there any good property management companies that you could recommend in Columbus, Ohio? And if so, what is the minimum amount of units that they will manage?
Really great question. We should it's honestly probably a good conversation for us to have offline, Sassy. Because there's some specifics and nuances and stuff that aren't really like generally applicable. I'll just say this. Look, the reality of this space is the lower asset class you buy, the worst property manager you're going to be able to pull, the worst property management pool you're going to be able to pull from. Class C property managers in general are, at least what we found, just to be real, are not good at what they do. And why would you be good at that space? You're dealing with like really tough tenant bases, eviction court, eviction notices, lots and lots of vandalism, lots and lots of heavy turnover. For what? For, collecting $600-700 a month in rent that you're making 4 to 8% on. Like, what's exciting about that opportunity? So Class C has been tough for us.
Okay.
And then we got a Class A building that we brought in a new manager that we were really excited about, and they haven't really been that great, to be honest with you. So we're kind of exploring other options right now. We've interviewed 2 or 3 other property management companies in Columbus. And I'm happy to share anything and everything I've got with you on all of them, but I don't really have a great go-to answer for you on that right now.
Okay. All right. Thank you. Oh, do you only, since you mentioned that you have a Class A building, do you only invest in Class A, or is it Class A and Class B?
No, it's well, we actually own some Class C that were Class C minus when we bought them.
Okay.
I would say in general, we're trending towards preferring more and more like the nicer asset class.
Okay.
There's so many reasons. The biggest one is just the tenant base, the tenant pool that you're working with. It's just different, and it's easier from a, kind of a catastrophic. I mean, weird things happen on Class C minus, Class D properties that I don't even want to talk about that have happened on our properties. So, it's just the nicer, in general, the nicer the asset, the better the tenant takes care of the asset, and the longer the tenant stays.
Okay.
All of which are very important.
Do you do Section 8 for any of your properties? I'm just asking.
I don't think we do have Section 8 right now, maybe in our one property in Mansfield we do.
Okay.
I think.
Okay.
Yeah.
Thank you.
Yeah, you're welcome. So I know are we kind of done here at the top of the hour, Johnny?
Yeah, that's kind of a soft stopping point.
Okay.
As we kind of cycle through the questions, I don't see any hands up right now. I think we had a really robust Q&A and kind of going through. Is there anything kind of you wanted to hit on? Especially, I think, speaking to, if you could rewind back when you had 0 doors and kind of where you were from a mindset perspective, just to kind of encourage those that's looking to take action this year and maybe do their first multifamily deal.
Yeah, I mean, if I could go back and coach myself at any point in time, but 8 years ago, 10 years ago, 5 years ago, I would have just taken me by the shoulders and like shaken me and gone, dude, get out of single family and get into the commercial space as fast as you can. And it's way more doable than it may seem. It's way more approachable and doable than it may seem to you. So I would leave you guys, I guess, kind of with that takeaway is like, you guys can do this. Look, you're here on a Wednesday night showing up for yourself to better your skills, your knowledge, to better your game. I mean, I think of this almost like athletics. Like everybody here is right now is like showing up for night practice and, shoot around. And so like, if you're doing these extra things and you're surrounded by people like Johnny, Reginald, myself, Faye, like you can get this stuff done. You really can. And it took a person giving a presentation one time for me to really get my head around that I could do this. And like, that person's now one of my best friends and I love him dearly. And I'm super grateful that he made me believe, so, yeah, that's like, hopefully the big takeaway is like, if you're not leveling up into like 80 units or 150 units, like think about leveling up into a 10 unit or a 20 unit or, and I actually don't believe that you have to graduate from one level to the next and take steps up. I think you can go from one level to this level way up here in one step, but some people like don't believe that about themselves, and in which case, like, just keep leveling up. If you're used to doing 1 unit, do 4 units. If you're used to doing 4 units, do 10 or 12. Like, really push the limit in 2023 is what I would encourage you guys to do.
Most definitely. Take one more question that popped up in my head. How was that transformation for you to kind of go into the partnership space to start doing bigger deals? Because I know that's one kind of limiting belief is like, oh, I don't want to partner, or you lose some of the control when you partner.
Yeah, I mean, honestly, if you are like a strict solopreneur and you really don't want to work with other people, this is probably not a good space for you. Because any big deal, and by big deal, I mean like if you took all the 100 unit or more transactions that happened last year, I would guess 90% of them were bought by multiple entities, or at least one entity that multiple parties are members of, if that makes sense. Yeah. It's really a partnership space. I mean, that's how stuff happens. And that's what you want. You want that. So if deep down inside you really don't like people and you don't want that, you don't want that teamwork, then there's other ways to do real estate and there's other ways to do business. So, but I personally think that if you're, like I said, if you're a strict solopreneur, like, maybe the Airbnb model is good for you or something like that.
Awesome. No, great perspective, brother. I appreciate that, man. I think that's all that we have tonight, man. You dropped so many gems and just share so much wisdom that I think I definitely appreciate it. Faye, do you have any feedback or anything, comments?
No, I'm just really super excited, and I think this is one of those videos that I'm gonna have to go back and review, because there's a lot of things that Tate dropped in there that's worth, like, kind of
unpacking a little bit,
some research.
Yeah.
Yes.
Yeah.
Or probably we can have you back on for another episode on a more what do you call that? A more in-depth on something, probably a case study or one
sure.
of your departments.
Yeah,
Nice.
happy to do that.
You guys want that?
Hey guys,
All right.
one real quick thing to mention, 2 quick things to mention. One is this best ever conference that's coming up in Salt Lake City in March. I have no affiliation with it. It's Joe Fairless's conference, and it's by far the best multifamily conference I've ever been to. It happens to be in Salt Lake City this year, which is where I live. It was in Denver last year. So highly recommend that. And then if anybody's interested in talking to me about the possibility of doing some one-on-one coaching, I did mention that before. But I do have, I think, about 3 slots left that I'm going to be taking one-on-one clients in, and it's an intense program. Like it's one you got to be ready to rock and roll for. But if you are, then it's probably worth a conversation. So yeah, on that, thank you so much, Johnny and Faye, and everybody else, Sassy and Reginald, for your questions. And yeah, it was a pleasure.
Yep, we'll definitely be dropping Tate's contact information and how you can book a call with him on the description box. So you guys can, we can definitely stay in touch. Appreciate you guys.
Perfect.
Yeah,
Yay.
most
Thank you
definitely.
so
I'll be
much.
reaching out to you as well, Tate, here soon the next week.
Okay, I love it. Sounds
Have a
great.
great one, guys. Good night.
Bye,
See you
everyone.
again. Bye.